Based on that, the regulations will be insurers will be regulated by both state government as well as the federal laws. Now, the constituents, what all included in the insurance markets? If we see, first one is common ownership. Many insurance companies are under a common ownership in which one corporation has one or more insurance business that act as independent companies. Now here if you see the insurance company under one common ownership, all the insurance companies will come under one particular ownership and which has one or more insurance business that act as a independent companies. The most common type of common ownership for an insurance company is when it is established as a captive insurer. A captive insurer can be formed to provide coverage for various types of business risk. Now, it is something the common ownership where all the insurance companies will fall under one particular ownership entity, and where they establish a captive insurer. Captive insurer means which provides coverage for different types of business risk. We have seen the types of risk previously. So different types of business risk, this coverage will be provided. Such an insurer we call him as a captive insurer. Usually it is a common ownership. This type of insurance where multiple insurance companies share the same losses. Now, this is a type of insurance where under common ownership, the multiple insurance companies will share the common type of losses. So that is the common ownership, because the name itself it is clear, common ownership, because the ownership is common for the group of insurance companies or multiple insurance companies. Same way the loss is also going to be common for this particular insurance companies which fall under common ownership category. Next, we have mutual insurance companies. Now, mutual insurance company is a company owned by policyholder. Now, this mutual insurance company is owned by the policyholder. This means each policyholder is given a vote to decide who will sit on the board of directors. Now, mutual insurance company is because insurance policyholders are also a stakeholder in the insurance company. He is also a part in the insurance company. Hence, at the time of deciding who will be the board of directors, one of the decision will be held with the policyholder. The policyholder will be given a vote, right to vote or select the particular board of directors. So they can select the board of directors who is going to sit in the particular position in the board of directors. So that we call it as mutual insurance company. A mutual insurance company can sell types of insurance or only provide one type of product or services to their customers. Now, mutual insurance companies either they sell a single insurance product, or they can sell a multiple insurance products. They can sell a combination, different types of insurance products, or single type of insurance product they can sell. The earnings from the mutual insurance company are distributed to the policyholders in the form of dividends. Now, whatever the earnings, whatever the profits we can say, we cannot use the word profit, but for your better understanding, I'm using it. We name it as earnings. Whatever the earnings that the mutual insurance company will get, that will be distributed to the policyholders in the form of dividends. So that is your mutual insurance company. Next is health insurance company is also a component in the insurance sector. Now, insurance market also contains companies that provide health insurance policies to individual as well as employees in the form of group health insurance policy. Now, most of you people might have heard that the people who are working in different sectors, different companies, the company is going to offer them an insurance policy, life insurance policy, health insurance policy for either as a group health insurance policy or individual health insurance policies will be provided. So that comes under your health insurance sector, health insurance industry. The companies that provide a group health insurance policy to an employer are regulated by a combination of federal and state laws. Any company who is providing group health insurance to its employees in the organization, which these health insurance, group health insurance are regulated by that particular state where they are, where the company is residing, and to the federal, laws. State can also provide health insurance to the residents if it is unavailable from private user because of the cost or ineligibility. Now, some of the countries, we can see that this particular state also providing health insurance to the residents of that particular state. So that is another, way of providing health insurance to the public, of public residing in that particular state. Hence, it is health insurance is another component which you can see in the insurance market. Then we have life insurance. Property and casualty insurer can also provide types of life insurance. A life insurance company can be a mutual insurance company or a part of stock insurance company. Now, this particular life insurance company, this can be a part of a mutual insurance company or it could be a part of the stock insurance company also. Now, life insurance company, it provides the life insurance policies to the insured parties for the health, for protection of their health. So that is your life insurance company. Company that provides life insurance usually offer financial products to their policy holders such as annuities and certain type of mutual funds. So this is the life insurance, which is another part in the insurance sector. Then we have stock insurance companies. Stock insurance company is a company owned by the stockholders. It is a company which is owned by the stockholders. Unlike the mutual insurance company, a stock insurer not only needs to protect its policy holders, but also maximizes the profits of the company policy holders. Now, in case of stock insurance, when we compare with the other sectors of insurance like health insurance or mutual insurance companies, stock insurance companies, it has got two main objectives. The first objective is, because it is insurance, they have to protect the policy holders. Along with protecting the policy holders, they also has to maximize the profits of company's policy holders. A stock insurance company can pay dividends to stockholders, but generally do not pay dividends to their policy holders. Now, in this stock insurance company, the dividends at the time of payment of the dividends to stockholders is possible, whereas dividends to policyholder is not possible in the stock insurance companies. Then you have property and casualty sector. Property and casualty insurers offer various types of insurance for individuals to purchase, such as automobiles and home insurance, homeowners insurance. We can see this type of insurance like vehicle insurance, if you are purchasing anything, or if you are purchasing any like mobile insurance. Recently we got mobile insurance. All that comes under your property and casualty insurance. A property and casualty insurer can also offer types of commercial insurance such as small sorry such as small business package, general business liability, umbrella policies, and workers' compensation. This comes under a small, the insurance policies which doesn't fall under the previous sector, previously discussed companies will fall under this property and casualty sector. Now these are the sectors, these are the constituents of insurance markets which we have seen. Constituents, it includes common ownership, mutual insurance companies, health insurance, life insurance, stock insurance companies, property and casualty are the components of insurance markets. Now, another topic we have is insurance company operations. Now, insurance company operations. What type of operations does the insurance company deals with? The most important insurance companies operations consist of rate making, underwriting, production, claim settlement, reinsurance. All these are the operations which the insurance company will deal with. Individually, let us discuss one after the other. First one is rating and rate making. A rate making refers to the pricing of insurance and calculation of insurance premium. Now, rate making here we mean rate, deciding the rate. So how much the premium that the insured party has to pay? What is the price of the insurance? All this will be decided in this rate making concept. A rate is a price per unit of insurance. Like obviously when we purchase anything, we will ask for the rate, right? Same way, a rate is a price of per unit of insurance. An exposure unit is a unit of measurement used in insurance pricing which varies by line of insurance. Now, exposure unit here we mean to how much risk the insured party is exposed to. Based on the risk exposure, the insurance pricing will be decided. The person who determines rates and premium is known as actuary. The person who fixes or determines, identifies the rate of insurance and the premium must be paid by the insured party. The, who will deals with these rates and premium, the person we call him as actuary. An actuary is highly skilled mathematician who is involved in all phases of insurance company operations, including planning, pricing, and research. So actually, because he is dealing with the figures, he is dealing with the numerical calculations, he must be very highly skilled, involved into the phase of insurance company operations, because he has to deal with the planning of insurance, pricing of insurance, as well as research in insurance. So this is rate making. Then rating. Rating is a process of multiplying a rate determined by actuaries by the number of exposures and then adjusted by various rating plans. Now rating means after the rate is fixed, after the rate making is done by the actuary, the person who fixes the rate, after the rate is fixed, then comes the rating process, that is providing with the ranking. It's something like ranking only. Okay. So rating is a process of multiplying a rate determined by actuaries, the person who determines the rate, by the number of exposure units, by the risk that is exposed to, and then adjusted by various rating plans, depending upon the rating plans. Usually we see that a rating will be given out of 5 ratings, how many ratings will be given? 1 is the least, 5 is the highest. So like that, it is the rating process. In life insurance, the actuary determines the premium for the life and health policies, and annuities also determined the legal reserves a company needs to future obligations. In case of life insurance, the actuary, the person who fixes the premium based on the life and health insurance policies with the insured parties have been taken, and he also determines the legal reserves a company needs for further obligations, for further any complaints, what type of legal reserves that the insurance company has to maintain. In property and casualty insurance, actuaries also determine the rates for different lines of insurance and also determines the adequacy of loss reserves, allocation of expenses, and compile statistics for company management and for state regulatory. If it is property or casualty insurance, the actuaries, the person will determine the rate based on the insurance, based on the adequacy of loss, that is based on the intensity of a loss of that particular property or casualty, and they will allocate the expenses, and they will also study the statistics, the expenditure, how the company is managing, both for the state regulatory as well as the company management purpose. So this is the rating process. Rating and rate making is first one. Rating and rate making. In life insurance, the actuary studies important statistical data on births, death, marriage, disease, employment, retirement, and accident. Because it is life insurance, it is related to the life of a person. So actually, before deciding the price, rate of the premium, and before deciding the claim amount, he has to study the statistical data both on number of births, deaths, marriages, disease, employment, retirement, and accidents. Based on this information, the actuary determines the premium for life and health insurance policies and annuities. The objective of calculating premiums are to make the business profitable. The main reason why we are calculating the premium is to make the business profitable, to enable the company to compete effectively with other insurers, because in the insurance market we don't deal with one insurer, we deal with different types of insurers. Hence there will be a competition between insurance companies. Hence with the help of these calculations of premium, it is easy for the company to compete with the other insurers effectively and allow the company to pay claims and expenses as they occur. Then the next one is underwriting. Underwriting refers to the process of selecting, classifying and pricing applicants for insurance. Underwriting, it is a process of we select the insurance policy, we classify the insurance policies and we price the applicants for insurance policies. The underwriter is a person who decides to accept or reject the applications. Now usually when we apply for an insurance policy, it is the underwriter who will decide whether to accept your application of insurance or to reject your application insurance. So that is a process of underwriting, and underwriting done by a particular person, he will be called as an underwriter. Statement of underwriting policy. An underwriting starts with a clear statement of underwriting policy. An insurer must establish an underwriting policy that consists with the company objectives. Any underwriter or any underwriting policy that the insurance company is having, they have to be consistent with the company objectives. The insurer underwriting policy is determined by top level management in charge of underwriting. Now, who will decide this underwriting policy? It is a top level management. It will decide the underwriting policy of insurance company. The underwriting policy is stated in detail in an underwriting guide that specifies. When we say underwriting policy, it is a written document in which some points will be included in that, how the insurance policy of that company should be. It specifies the lines of insurance to be written, territories to be developed, forms and rating plans to be used, acceptable broad line and prohibited business, amounts of insurance to be written, business that requires the approval by a senior underwriter, and other writing details. So all these details will be included in a particular underwriting policy of an insurance company. Then statement of underwriting policy. When we see the statement of underwriting policy, an insurer must establish an underwriting policy that is consistent with the company objective. As we have seen earlier that whenever there is a underwriting policy that is taken up, that is written by the underwriter, it must be inconsistent with the company's objectives. It cannot go deviated from the company's objective. Whatever the company objective is there, according to that only, according to the achievement of those objective only, the underwriter policy must be established or framed. The objective may be large volume of business with a low profit margin or smaller volume with a large margin of profit. The objective could be anything. The objective could be large volume of business with low profit. Either the profit margin will be less and the volume of sales will be more, or volume of sales will be less and the profit will be more. It depends upon the type of the insurance company. The insurance underwriting policy is determined by top level management in charge of underwriting. Now, who will deal with this in underwriting policy? It is the top level management of the company will deal with the insurance underwriting policy. And the underwriting policy is stated in detail in an underwriting guide that specifies the lines of insurance to be written. So there will be a written document, that is the underwriting guide will be there. In that the lines of insurance will be written clearly regarding the underwriting policy. Policy cannot be same for every company. Policy differs from company to company because each company has got different objectives. So depending upon the different companies' objectives, different underwriting policies will be there. The basic underwriting principles. when going with the underwriting policy, some of the basic principles that the underwriter has to follow, the principles are, first principle is that the underwriter must select prospective insured according to the company's underwriting standards. According to the company standards, the underwriter must select the prospective, that is concerned insured, that is who is the targeted insured parties, that is the policy holders. Based on the policy holders only, the underwriting must be done. Second is, underwriter principle is to have a proper balance with each rate classification. He should have a clarity on what is the rate classification for different types of insurance policies. And the third is, underwriting principle is equality among the policy owners. He should follow the equality among the policy owners. He cannot make a partiality towards the policy owners. Hence, all policy owners should be treated equally, and the principle of equity should be followed among the policy owners. These are the three main principles of underwriting. Then steps in underwriting. After the insurer's underwriting policy is established, once the policy is framed, once the underwriting policy is done clearly and established, then it must be communicated to the sales force. Ultimately, it is the people who are selling the insurance policies. For them, what is the underwriting policies they need to know. So it must be discussed with the sales force. Initially, underwriting starts with agent in the field. Underwriting starts with the agent that who deals, we usually call him as life insurance agents, right? So agents will start with the underwriting stage. Agent as the first underwriter. In the process of underwriting, agent acts as a first underwriter. In this step, he is often called field underwriting because he is working on the field. He will go to the insurance policy holders, to the public, to sell the life insurance policy. Hence, he will be called as a first underwriter, and also he will be called as a field underwriter. The agent is told that what type of applicants are acceptable, broad line or prohibited. Now, what type of applicants are acceptable, what can be taken considered as a broad line, that is the limiting factor, and what cannot be accepted, that means it must be prohibited. So as an agent, when he is dealing with the sales of the insurance policy, he must be very clear that what type of applicants should be acceptable, what should be rejectable, and what are on the borderline. Then sources of underwriting information. The type of information varies by type of insurance policies. Information varies from insurance policies. One insurance policy information will differ from another insurance policy information. Hence, there should be a clear differentiation between from where the information we are gathering. The application is the basic source of underwriting information. Suppose we are taking insurance policy, we need to fill a document, insurance policy document we need to fill. Based on that, we can easily identify the underwriter information. An agent reports is another source of information. First source of information is application. Second source of information is agent's report. Agents will also have an information report. So that is your second source. And another source of information is companies requires the agent to give the evaluation of prospective insured. Now, as a company will ask the agents to provide with the prospective insured details. A physical inspection may also be required before an application for property and liability insurance is approved. Before approving the property insurance or liability insurance, say for example, if you are taking insurance for a mobile, we should have the mobile first with us, then only we can go with the application of insurance, product insurance, mobile insurance. So who will verify? It is an underwriter who will verify through the physical inspection of the particular mobile. Like that, examples. So these are the steps involved in the underwriting of policy. Making an underwriting decision. There are three basic underwriting decisions with respect to initial application for the insurance, accept the application subject to certain restrictions or modifications, and reject the application. Now finally, once the underwriting policy is done, underwriting agent accepts the information, provides the information. Now it is the decision whether to accept the application or accept the application certain limited to certain restrictions, or reject the applications or make the modifications. It is the underwriting decision. Now, while making the underwriting decisions, making an underwriting decision, after the underwriter evaluates the information, after collecting the information, the underwriter will evaluate the information, will study the information. An underwriting decision must be taken. After studying the entire information clearly, thoroughly, then they will take the decision. There are three basic underwriting decisions with respect to initial applications of the insurer. Three basic decisions are there. First is accept the application. Accept the application. First one is we accept it. Second one is we accept but to the certain restrictions or modifications. Third one is you reject the applications. Many insurance now use computerized underwriting for the certain personal lines of insurance that can be standardized because everything is automated now. Previously, underwriters have done this particular process physically, but now because of the automation, because of the technological advancement, the computerized underwriting process is also available where they can go with taking the underwriting decision. Then we have something called production in the concept of underwriting. Production, the term production refers to sales and marketing activities of the insurance. Now, production here we mean selling the, we are not producing, we are not making anything. Instead of that, what we are doing is we are selling the insurance policies or we are marketing the insurance policies. Agents who sell insurance are frequently referred to as producers because they are the selling, they are referred as producers. This word is used because an insurance company can be legally chartered, personnel can be hired and policy forms printed, but no business is produced until a policy is sold. Now, why we are using this word production is until a policy is sold, until the insurance policy is sold, we cannot treat a particular person as a salesman or agent or any other, particular name we cannot give to that particular person because as per the insurance regulations, once a policy is sold, then only the business is established is what it is understood in the insurance policy. Hence, we are using the term production. But production doesn't mean we are not producing anything. We are just selling the insurance policy. The person who sells the insurance policy is an agent. He is also treated as a producer. Agency department life insurance have an agency or sales department. Agency department is responsible for recruiting and training new agents and for the supervision of general agents. Professionalism in selling in marketing insurance has been characterized by the distinct trend towards professionalism in recent years. Now, ultimately, in the term of production, we are dealing with the selling. That sales will be done by the agents, that is insurance agents or insurance producers. Now, there is a separate department, agency department, which is responsible for recruiting and training new agents for the supervision of the general agents for the sale, for the increased sales of insurance policies. Agents will be recruited and trained by the agency department. This is the production. Then we have claim, concept of claim. Claim is a right insured to receive the amount secured under the policy of insurance contract promised by the insurer. Now, as a policy holder, after the policy is taken, now claim is the amount that the insured party has got the right to receive the amount after the completion of the particular contract by the insurer. Because insurance is a contract between the insured and the insurer. ఇన్సూరర్ కి మనము ప్రీమియం ఇన్సూర్డ్ ప్రీమియం పే చేస్తాడు. ఇన్సూరర్ వచ్చేసి క్లెయిమ్ ఇవ్వడం జరుగుతుంది ఇన్సూర్డ్ పార్టీకి ఎట్ ద ఎండ్ ఆఫ్ ది క్లోజర్ ఆఫ్ ది కాంట్రాక్ట్ ఆర్ ఎట్ ద ఎండ్ ఆఫ్ ది లైఫ్ ఇఫ్ ఇట్ ఈస్ ఎ లైఫ్ ఇన్సూరెన్స్. Insurance claim is a request of the insurance policy holder, beneficiary from the insurer, insurance issuing company for financial reimbursement whenever he or she suffers a loss of the insured property, life, health, etc. If it is a health insurance policy where the policyholder will receive the claim. If it is a life insurance policy, then the claim received by the insured party from the insurance company. So like that, insurance claim is the amount which is received by the insurance policy holder if when he or she suffers a particular loss or when the contract is gets an end. Now claim settlement, payment of claim is the ultimate objective of life insurance and the policy holders has awaited for it for a quite long time and in some cases for the entire lifetime, literally for the payment. Now, claim settlement is payment of claim, that is payment of policy, insurance policy total amount by the policy holder, by the insurance company to the policy holder. It is a final obligation of the insurer in terms of insurance contract as the policy holder has already carried out his obligation of paying the premium regularly as per the conditions. Because the policyholders has paid the insurance premium regularly as per the conditions mentioned in the policy contract, in the scheduled of a policy contract, according to that, because he paid the insurance premium regularly, now after closure of the policy document, now it is time the insurance company has to give the payment to the insured party, that is your claim settlement. There are three types of claim settlement in the life insurance policy. One is survival benefit, maturity benefit, death benefit. Three type of benefit claims. One, if a person expires, if a person is faces the death, then he will be getting death claim settlement. If the contract gets completed, matured, then maturity benefit. Survival benefit is also another type of claim settlement process. Now, in this claim settlement, we have types of claim adjusters. The person who adjusts a claim is known as a claim adjuster. The person who adjusts the claim is a claim adjuster. An insured officer agent often has authority to settle small party claims up to maximum limit. Now, because as an insurance agent, he has got the permission to settle the small party claims up to a maximum limit. A company adjuster can settle, one of the type of the adjuster is company adjuster. A company adjuster can settle a claim up to 20,000. The adjuster is usually a salaried employee. When we say company adjuster, he is an employee in the insurance company and he represents only one company, is a company adjuster. An independent adjuster is also be used as a claim settlement. He is another type of adjuster, independent adjuster. An independent bureau can be used to settle claims. That is, independent adjuster is used to settle the claims. Then the public adjuster is a third type of adjuster will be involving in settlement of a claim. A public adjuster, however, represents the insured rather than the insurance company and is paid a fee based on the amount of the claim settlement. Like he will get some percentage. If the claim settlement is 10 lakhs, maybe 1% or 2% of the claim amount he will be paid. So that is a public adjuster. So we have seen a company adjuster is a first type of claim adjuster. Independent adjuster is the second type of claim adjuster and the public adjuster is the third type of claim adjuster. Then steps in claim settlement. Now there are several steps in the settling a claim. First one is notice of loss. First we need to, as an insured party, policy holder first insurance company ki inform cheyali that the loss they are facing. If it is health related issue, this is the health problem that we are facing, hence I go with the claim settlement. That notice must be given to the insurance company first. Then after notice is received, the next step is investigating the claim. Once notice మనం పంపించిన తర్వాత ఇన్సూరెన్స్ కంపెనీ ఇప్పుడు ఇన్వెస్టిగేట్ చేస్తుంది అకార్డింగ్ టు ద లాస్. అసలు లాస్ ఎందుకు వచ్చింది, ఎంత వచ్చింది అనేది దాన్ని ఎస్టిమేట్ చేయడం జరుగుతుంది. ఇన్వెస్టిగేటింగ్ ద క్లెయిమ్ అండ్ అడ్జస్టర్ మస్ట్ ఆల్సో డిటర్మైన్ ద అమౌంట్ ఆఫ్ లాస్. అక్కడ అడ్జస్టర్ వచ్చేసి మనకి ఎంత లాస్ అమౌంట్ ఎంత లాస్ అయ్యింది అనేది అది ఇన్వెస్టిగేట్ చేయడం జరుగుతుంది. An adjuster may require a proof of loss before the claim is paid. మనం ఎప్పుడైతే మనకి లాస్ జరిగింది అని చెప్తున్నామో ఓరల్ గా కాకుండా డాక్యుమెంటల్ ప్రూఫ్ కూడా మనం సబ్మిట్ చేయాలి. వాట్ ఈస్ ద లాస్? If it is health insurance, what we have to do is we have to submit all our health related profile, related reports we need to submit. Depending upon that loss, he will determine, we will estimate the particular loss amount. అంటే ఎంత లాస్ జరిగింది, ఎంత వాళ్ళు పే చేస్తున్నారు అనేది ఎస్టిమేషన్ కోసం అని చెప్పి we have to submit the proofs. A proof of loss is sworn statement by the insured that substance of loss. After the claim is investigated, the adjuster must make the decision concerning the payment. As I told you, a proof of loss మనం సబ్మిట్ చేయాలి. అది సబ్మిట్ చేసిన తర్వాత సబ్స్టాన్షియల్ లాస్ ఎంత ఉంది అనేది, అంటే ఆ లాస్ ఎంత అమౌంట్ వరకు ఉంది అనేది దాన్ని అతను ఇన్వెస్టిగేట్ చేసి, అడ్జస్టర్ ఇన్వెస్టిగేట్ చేసి, he will make a decision regarding how much the payment must be done. So this is the steps in claiming of a settlement of a claim policy. Then we have reinsurance. Then we have reinsurance. Reinsurance is a contract between two or more insurance companies by which a portion of risk of loss is transferred to another insurance company. Now, reinsurance is a contract between two or more insurance companies. That is, insurance policy ni ఒకటి కన్నా రెండు, one or more companies will share the risk together. That process we call it as reinsurance. అంటే ఇన్సూరెన్స్ ని షేర్ చేసుకో, ఇన్సూరెన్స్ పాలసీ రిస్క్ ని షేర్ చేసుకునే ప్రాసెస్ ని మనం reinsurance అని అంటాం. This happens when an insurance company has undertaken more risk burden on its shoulders than its bearing capacity. When the reinsurance is possible, when the insurance company is facing too much loss which the company cannot bear, then they will go with the reinsurance. Double insurance is thus a device to reduce the risk. Reinsurance ne manam double insurance అని కూడా అనొచ్చు. Now it is double insurance is a tool or it's a device which will reduce the risk that a company is going to face. That the company is going to face. Now, some of the definitions when we see here is, according to Federation of Insurance Institutes, Mumbai, reinsurance is an arrangement whereby an insurer who has accepted an insurance, that is the insurer or the insurance company who accepts the insurance, transfers part of the risk to another insurance. He will transfer, that is the one insurance company transfers his part of risk to another insurance company so that his liability on any one risk is limited to figure proportionate to his financial capacity. Because he is sharing the risk, అతని ఫినాన్షియల్ కెపాసిటీని బేస్ చేసుకుని ప్రపోర్షనేట్ గా ద రిస్క్ హీ కెన్ ఫేస్ ఇట్. So that is reinsurance definition. Another definition by Rigel and Miller. Reinsurance is the transfer by an insurance company a portion of its risk to another company. It's a transfer of risk from one company to the another company. That is your reinsurance. When we see the features of reinsurance, reinsurance is a contract of indemnity. Contract of indemnity. The word indemnity we mean it is a protection against damage or loss. So reinsurance is basically it is a contract which will protect the insurance company from taking up too much risk. Hence reinsurance is a contract of indemnity. It is an insurance contract between two insurance companies. Now insurance policy is a contract between company and policyholder, whereas reinsurance is between two insurance companies. The relationship of the insured remains with original insurer only. That is, the relationship exists between the original insurer only. The reinsurer is not liable directly towards the assured. Say for example, A is the policy holder, B is insurance company, C is insurance company. A has taken policy from A. A has taken policy from the B. Now, insurance policy is between A and B. B is the company, A is the holder. They both have entered into a contract, insurance contract. Now, B is facing too much of risk, hence he entered into a reinsurance contract with the C. Now, there is a contract, reinsurance contract between B and C, whereas insurance contract is between only A and B. So here, because the insured party is related to only A, that is policyholder A is related to B, there is no direct contact between A and C. There will be only contact between A and B. So C and A cannot meet directly because there is no relationship of contract that exists between A and C. Hence, reinsurance, so we are saying that the policy will be shared by, the risk of the policy will be shared by two different companies, but the third company cannot have direct relationship with the insured party. In reinsurance, the insurer transfers the risk beyond the risk limit of his capacity to another insurance company. Basically, in reinsurance, because the insurance company cannot bear the risk, high risk, hence they are transferring their part of risk to the another company. Reinsurance does not affect the right of insured. Because the insurance risk is shared by more than one company, that doesn't have any effect on the rights that the policyholder has got. The original insurer cannot do reinsurance more than the insured sum. If the original insurance policy is for 10 lakhs, the insurer also has to do, that is the insurance company can go with the reinsurance policy up to 10 lakhs, but he cannot go beyond the 10 lakhs. So more than the 10 lakh, more than the insured sum is not possible in the reinsurance. Reinsurance can be possible in all types of insurance. So it is insurance company can go with the reinsurance of the contract with any type of insurance policy. The fundamental principle of insurance are applicable in reinsurance also. Whatever the insurance principles we follow at the time of taking up the policy, the same principles of insurance are applicable for the reinsurance also. There are no separate principles that are applicable for the reinsurance or insurance. Both have the same principles. Reinsurance is bound only those liability for which the original insurer is legally liable. Now, reinsurance is having a legal liability that is equal to the liability of the original insurer which is going to have. These are the features of reinsurance. Then the advantages or the merits of reinsurance is, one of the major advantage of reinsurance is because it helps in transferring the risk by one company to the another company. That is one of the major advantage we can insurance companies can have with the reinsurance. So reinsurance is a security for the insurers. He can share his risk with the other insurers. It increases the capacity of the insurer of undertaking insurance large sums without any hesitation. Many smaller companies can also go undertake heavy risk. Now, because reinsurance helps the insurance companies to go with the large sum of insurance policies without any hesitations, because now they can go with the reinsurance by which they can reduce their risk capacity. It reduces the situation of uncertainty by distribution of risk among the other insurers. The uncertainty will be reduced with the help of the reinsurance. It encourages the new and small insurers to undertake more risk and remain in the business, because the risk will be transferred by more than one insurer companies. Hence, with the help of the reinsurance, new and small insurers also can go with taking the high profile risk-oriented policies. It makes possible for the insurer to insure catastrophic risk like the natural calamity risk, which we can say like flood, earthquake, cyclones, etc. Such type of normal risk can also be possible to undertake in the reinsurance policies. It brings the stability of earnings, the profit by distributing risk among the many parties. That is, many insurance companies deal with the different risk, different types of insurance policies. Hence, earnings will be stabilized by the insurance companies. It brings stability in income by reducing the liability. With the help of reinsurance, it helps in reducing the liability and bringing the stability of earnings. Reinsurance is most useful to new insurers who bear loss capacity to undertake the risk. It is more useful or it is more benefitable to the new insurance companies who bear the loss capacities to undertake the risk. These are the advantages of going with the reinsurance policies by the insurance companies. Now we have got types of insurance, types of reinsurance. We have two types of reinsurance: facultative reinsurance, treaty reinsurance. Facultative reinsurance, it is an optional case-by-case method that is used when the ceding company receives the application for insurance that exceeds its retention limit. Now, factual reinsurance means if the insurance policy has more than the retention amount, then they can go with the ceding of the company. That is case-by-case method they can go with. We call it as facultative reinsurance. Facultative reinsurance has the advantage of flexibility because reinsurance contract can be arranged to fit any kind of case. Because it is having the flexibility, it can be adjustable to any kind of policy, any kind of insurance policy. Then treaty reinsurance, it means the primary insurer has arranged a seed insurance to the reinsurance, and the reinsurance has agreed to accept the business. Treaty reinsurance has several advantages to the primary insurer. It could be unprofitable to the reinsurer. There are several types of reinsurance treaties and arrangements. Now, treaty reinsurance means they will come to an understanding. That is, the insurance companies will come to an understanding of accepting the agreeing and accepting towards the business that they are going to deal with. So that is a treaty reinsurance. We have got other types of treaty reinsurance. One is quote share treaty, surplus share treaty, excess of treaty reinsurance pool. Quote share treaty means the reinsurer agrees to share premium and loss based on some proportion. They will share the quote, that is the proportionate 2:1, 1:2 kind of a thing. They will share the proportion. In surplus, whatever the surplus amount is there, they will share the maximum surplus amount. Then excess of treaty reinsurance pool is designed largely for catastrophic reinsurance. The last one, excess of treaty reinsurance, is mainly meant for catastrophic losses, that is unexpected losses, that is due to earthquake, floods, or anything else like that, the natural calamity loss. So for that, the last one is mentioned. So these are the types of reinsurance which we can see. Now these are the operations of insurance companies. The next concept we have is operations of intermediaries. Now we have seen what the insurance companies will do. Now let us understand what the intermediaries will do. Now who are these intermediaries? Intermediary is a person, or it could be a company also, that is a group of persons, will help in buying insurance policy. That is, insurance intermediary acts as a mediator between the insurers, that means insurance company ki customers ki ante policy holders ki madhyalo unna valle insurance intermediaries. It could be insurance agents, insurance brokers, financial advisors, or any other person who acts as a intermediary in between party between the insurance companies and the policy holders. Now, an insurance intermediary in India is an individual or business that acts as a link between insurers and customers. Insurance industry intermediaries are the individuals or the business who acts as a link between the policy holders and the insurance companies. An insurance intermediary can be used to refer to as, it could be an insurance agent, a corporate agent, or an insurance broker, surveyor, third-party administrators, TPAs, are also insurance intermediaries. Let us study about all these intermediaries individually. Now, types of insurance intermediaries. First one we have is insurance agent. Anyone licensed by the Insurance Regulatory Development Authority of India, IRDAI, to solicit and procure insurance business, including business pertaining to continuation, renewal, or revival of insurance policies, is considered as agent. Now, as an insurance agent, he must get a license from the IRDAI to continue to deal with the insurance business in India. So, who will be called as an agent if he get a license from the IRDAI to deal with the insurance business in India? Now, what he will do is he will deal with the continuation of the insurance policy, renewal of the insurance policies, and revival of the insurance policies. Such a person we call him as insurance agent. An agent is a person who acts as a middleman on behalf of the insurance provider. అంటే ఇన్సూరెన్స్ కంపెనీకి తరఫున ఒక పర్సన్ అనే అతను ఉంటాడు, మిడిల్ మెన్ లాగా, అతన్ని మనం ఏజెంట్ అని అంటాం. An agent is a license to work as an agent. Agent ని మనం ఏజెంట్ అని ఎప్పుడు అంటాము అంటే if he get license for both general insurer as life insurer, which is known as composite insurance agent. జనరల్ ఇన్సూరెన్స్ పాలసీస్ అయితే సపరేట్ ఏజెంట్ ఉంటాడు, లైఫ్ ఇన్సూరెన్స్ పాలసీస్ కి సపరేట్ ఏజెంట్ ఉంటాడు. ఈ రెండింటిని కలిపి జనరల్ ఇన్సూరెన్స్, లైఫ్ ఇన్సూరెన్స్ రెండు ఇన్సూరెన్స్ ని డీల్ చేస్తున్నాడు అని అంటే అతన్ని మనం కాంపోజిట్ ఇన్సూరెన్స్ ఏజెంట్ అని అంటాం. బికాస్ హీ ఈస్ డీలింగ్ విత్ టూ టైప్స్ ఆఫ్ ఇన్సూరెన్స్. సో దట్ ఈస్ an insurance agent. Then corporate agent, an organization or individual that solicits and provides insurance policy for a particular type of life, general or health insurance is known as corporate agent. Corporate agent, it could be an individual or it could be a company who deals with the insurance policy of any type, whether it is health, whether it is property, whether it is life, general, any type of policy he is dealing with, he will be called as a corporate agent. They often work in certain insurance field and may represent one or more insurance. They work in the insurance field and they represent more than the one insurance. అంటే వీళ్ళు యూజువల్ గా ఒక ఇన్సూరెన్స్ కంపెనీ సైడ్ నుంచి పనిచేయరు, కొన్ని మోర్ దెన్ వన్ ఆర్ టూ ఇన్సూరెన్స్ కంపెనీ సైడ్ నుంచి వీళ్ళు వర్క్ చేయడం అనేది జరుగుతుంది. For instance, a car dealer might provide auto insurance while a travel agency would provide a travel insurance. A corporate, if it is auto dealer అంటే ఆటోమొబైల్ ఇండస్ట్రీలో బైక్, ఇప్పుడు మనం బైక్ హోండా షోరూమ్ అంటే ఎక్కడికైనా వెళ్ళినప్పుడు వి విల్ అక్కడ ఉన్న ఇన్సూరెన్స్ పార్టీ ఓన్లీ ఆటోమొబైల్ ఇన్సూరెన్స్ మాత్రమే ప్రొవైడ్ చేస్తారు. అదే ట్రావెలింగ్ లో అయితే ట్రావెల్ ఇన్సూరెన్స్ మాత్రమే ప్రొవైడ్ చేస్తారు. కార్పొరేట్ ఏజెంట్ కి వచ్చేసరికి హీ సెల్ ద పాలసీస్ ఫ్రమ్ మల్టిపుల్ ఇన్సూరర్. అంటే ఈ కార్పొరేట్ ఏజెంట్ దగ్గర డిఫరెంట్ టైప్ ఆఫ్ ఇన్సూరెన్స్ పాలసీస్, డిఫరెంట్ టైప్ ఆఫ్ ఇన్సూరెన్స్ కంపెనీతో ఇతను డీల్ చేయడం జరుగుతుంది. హెన్స్ హీ విల్ బి కాల్డ్ యాజ్ అ కార్పొరేట్ ఏజెంట్. Then insurance broker. Now, insurance broker is an individual or entity registered with IRDAI and authorized to solicit and arrange the insurance and reinsurance and their clients with insurers or reinsurers located in India, overseas, or provide claim consultancy, risk management, or other services authorized in India as per the IRDAI regulations 2008. Now, agent వచ్చే వరకు అతని ఇండివిజువల్ పర్సన్ లేదా ఒక గ్రూప్ ఆఫ్ పర్సన్స్ they deal with the insurance policies only, whereas insurance broker is something, it is an individual or a entity. అంటే ఇది ఒక కన్సర్న్, ఇది ఒక ఆర్గనైజేషన్ లాగా కూడా ఫామ్ అవ్వచ్చు. దే హ్యావ్ టు రిజిస్టర్డ్ విత్ ద ఐఆర్డిఐ. ఏజెంట్ కి లైసెన్స్ తో పని ఉంది, బ్రోకర్ కి రిజిస్ట్రేషన్ తో పని ఉంటుంది. రిజిస్ట్రేషన్ విత్ ఐఆర్డిఐ టు డీల్ విత్ ఇన్సూరెన్స్, reinsurance, risk management, claim settlement, any other services related to the insurance, whether it is within India, outside India, overseas. It deals with every aspect of insurance. That is an insurance broker. If you see, the difference is given here. Agent is somebody who legally represents the principal and has the authority to act on behalf of the principal. Principal here we mean insurance. ఇన్సూరెన్స్ కంపెనీకి బిహాఫ్ గా తరఫున ఏజెంట్ ఉంటాడు. Broker is someone who legally represents the insured even though he or she receives a commission from the insurer. బ్రోకర్ వచ్చేసరికి ఇన్షర్డ్ పార్టీ తరఫు నుంచి ఉంటారు, అంటే పాలసీ హోల్డర్ సైడ్ నుంచి ఉండే వాళ్ళని బ్రోకర్స్ అని అంటారు. ఇన్సూరెన్స్ ఏజెంట్ ప్రొవైడ్స్ పాలసీస్ and acts as a mediator between insurer and policy owner. Insurance broker negotiate the insurance products that will suit their clients' need in exchange for compensation. సే ఫర్ ఎగ్జాంపుల్ ఇప్పుడు మనకి ఏ పాలసీ తీసుకోవాలో మనకు ఐడియా లేదు, మనకి ఇన్సూరెన్స్ గురించి అసలు క్లారిటీ లేదు, కానీ ఇన్సూరెన్స్ ప్రొడక్ట్ తీసుకోవాలి అని అనుకుంటున్నప్పుడు we cannot go to the agent, we have to go to the broker, because broker will think from the policy holder's perspective, not from the insurance company perspective, whereas insurance agent thinks from the insurance company's perspective, not from the policy holder's perspective. So these are the basic differentiation which we can see between the insurance agents and insurance brokers. Now, role of insurance intermediaries. What type of role does these intermediaries play? Asal intermediaries avasarama. The role of insurance intermediaries as players with both broad knowledge of insurance marketplace, including products, prices, and providers, and an acute sense of needs of insurance purchasers. Intermediaries have a unique role. Because we need intermediaries because they have complete knowledge on insurance products, insurance policies, prices, who will provide these insurance policies, how to take this, everything will be known by the insurance intermediaries. Hence, as a policy holder, we have to be in contact with the insurance intermediaries. Hence, these intermediaries will play a major role in the insurance industries. Intermediary activity benefits the overall economy at the both national and international levels. At international level and at the national level, it is very important to have a insurance intermediary. Without the protection from the risk that insurance provides, commercial activities would slow, perhaps grinding it to halt, thus turning to eliminating economic growth and financial benefit to the business and individuals which such growth provides. Now, because of this insurance intermediaries, we could able to protect our life as an individual. When it comes to business, they are protecting towards the risk which they are going to face in a day-to-day life. Hence, this way, they are eliminating the risk and by increasing the growth and financial benefits to the individuals with the help of these intermediaries. Now, the role of intermediaries is market access. Insurance intermediaries will have మార్కెట్ యాక్సెస్, మార్కెట్ లో ఇన్ఫర్మేషన్, ప్రతి ఇన్ఫర్మేషన్ మనకి ఇన్సూరెన్స్ ఏజెంట్స్ దగ్గర, ఇన్సూరెన్స్ బ్రోకర్స్ దగ్గర, ఇలాంటి ఇంటర్మీడియరీస్ దగ్గర కంప్లీట్ ఇన్ఫర్మేషన్ ఉంటుంది. Now, if I want to know everything about the market, we can easily contact the broker or the agent. So they will have complete market access. Risk evaluation. The role of insurance intermediary is to evaluate the client's risk profile. పర్టికులర్ పాలసీ హోల్డర్ ఎంత రిస్క్ ఫేస్ చేస్తున్నాడు, అతని ఫర్దర్ లైఫ్ స్టైల్ అండ్ లైఫ్ స్పాన్ లో ఆ రిస్క్ ప్రొఫైల్ అనేది కంప్లీట్ గా ఇవాల్యుయేట్ చేసేది మనకి బ్రోకర్స్ ఆర్ ఏజెంట్స్. Hence, intermediaries are very important in evaluating the risk of the individual person, or it may be for the business also. Policy selection. Insurance policy, we have n number of policies that are available depending upon the requirements of different policy holders, different general public. Now, మనకి ఏ పాలసీ సెలెక్ట్ చేసుకోవాలి అనే దాంట్లో ఇన్సూరెన్స్ ఇంటర్మీడియరీస్ will help us in selecting the appropriate policy depending upon our needs and our benefits. Customization. Insurance brokers can work with the insurers to have policies tailored to the specific requirements for their clients. ఇప్పుడు మనకు పర్టికులర్ పాలసీలో కొన్ని చేంజెస్ కావాలి అని అంటే ఏజెంట్ మనకి చేయలేదు. ఏజెంట్ పాలసీని ఎలా ఉంది అలాగే అమ్ముతారు తప్ప పాలసీలో చేంజ్ చేయలేదు. కానీ బ్రోకర్స్ ఏం చేస్తారు అని అంటే ఇన్సూరెన్స్ కంపెనీతో మనకు కావాల్సిన విధంగా పాలసీస్ ని ఫ్రేమ్ చేయిస్తారు. సో దట్ ఈస్ ఇంటర్మీడియరీ హెల్ప్ అస్ ఇన్ కస్టమైజింగ్ ద పాలసీస్. ప్రైస్ బార్గెనింగ్. Intermediaries can frequently bargain on their clients' behalf. మనం యాజ్ ఎ పాలసీ హోల్డర్ మనం ఎప్పుడు ఇన్సూరెన్స్ కంపెనీతో డైరెక్ట్ గా డీల్ చేయలేము. అప్పుడు ఈ బ్రోకర్స్ ఈ ఇంటర్మీడియరీస్ ఏం చేస్తారంటే మన సైడ్ నుంచి ఈ ప్రైస్ బార్గెనింగ్ అనేది చేయడం జరుగుతుంది. ఫర్ దట్ వి రిక్వైర్ ఇన్సూరెన్స్ ఇంటర్మీడియరీస్. Policy administration. Intermediaries help with responsibilities related to policy administration, such as handling claims, policy renewal, anything which is related to the policy. Insurance intermediaries will help us in dealing with the policy related administration. So these are the various role that the intermediaries will play in the insurance policy dealings. I hope the concept is very much clear to you all. In the next class, we will deal with other more topics. Have a nice day. We'll meet again in the next class. Thank you.